It starts with a faint whisper. The uneasy conversations of financial analysts, quiet murmurs on economic forums, and scattered headlines warning of instability. But whispers have a way of growing louder. And today, that whisper has become a question that haunts the minds of millions. Is the global banking system on the verge of collapse? To understand how we got here, we need to rewind the clock, to dissect the fragile mechanisms underpinning the financial world and the domino effects that have brought banking systems to the brink in the past. But most importantly, we must explore whether the current system can withstand the storms forming on the horizon. The story begins with a lie we all accept as truth: that banks are the safest place for your money. You deposit your hard-earned dollars, trusting that these institutions will safeguard them. What most people don't realize is that banks only hold a fraction of the money they promise to protect. This is the principle of fractional reserve banking. For every dollar you deposit, a bank is required to keep only a small percentage in reserve, sometimes as low as 10% or even less. The rest is loaned out, invested, or leveraged. This system works well until it doesn't. Imagine a scenario where a wave of panic ripples through the population. Maybe it's triggered by rumors, a poorly handled statement by a banking official, or the collapse of a smaller financial institution. Suddenly, depositors rush to withdraw their money. But the bank doesn't have enough cash on hand to cover all these withdrawals. This is what's known as a bank run. And in a highly interconnected global economy, one bank's failure can spark a chain reaction that destabilizes the entire financial system. This isn't hypothetical. We've seen it before. Let's talk about 2008, the year the world came to the edge of financial catastrophe. It started in the housing market, with subprime mortgages handed out like candy to borrowers who couldn't repay them. These risky loans were then bundled into complex financial products called mortgage-backed securities and sold to investors as safe investments. But when housing prices fell, the entire system unraveled. Major institutions like Lehman Brothers collapsed under the weight of their own greed and mismanagement. Panic spread like wildfire. Stock markets plunged. Retirement accounts evaporated overnight. It was the closest the world had come to another Great Depression since the 1930s. Governments and central banks intervened, pumping trillions of dollars into the financial system to prevent total collapse. But this rescue came at a cost. The money wasn't conjured out of thin air, it was added to national debts. And those debts have only grown larger over the years. Fast forward to today. Many of the underlying problems from 2008 haven't been solved. They've been papered over. Debt levels, both public and private, have reached historic highs. In the United States alone, federal debt has surpassed $33 trillion. That's more than the entire economy produces in a year. Meanwhile, household debt is skyrocketing as Americans struggle with rising inflation, stagnant wages, and skyrocketing costs of living. But it's not just the debt. The banking system itself is increasingly fragile. One major reason? Over-leveraging. Banks don't just lend out your deposits. They use those deposits as collateral to borrow and invest even more. This creates a delicate balancing act where a single bad investment can lead to insolvency. Take the recent rise in interest rates. After years of near-zero rates, central banks around the world have been forced to hike them to combat inflation. But higher interest rates mean higher borrowing costs, which can push over-leveraged banks into dangerous territory. And when banks start failing, the ripple effects can be devastating. Consider Silicon Valley Bank, a tech-focused financial institution that crumbled in early 2023. The bank had bet heavily on long-term government bonds, which seemed safe at the time. But when interest rates spiked, the value of those bonds plummeted. Suddenly, the bank's balance sheet looked shaky. Customers panicked, and within days, the bank collapsed. It was a stark reminder of how quickly things can unravel. The problem isn't isolated to the United States. Europe's banking sector is grappling with its own set of challenges. In Germany, Deutsche Bank has been plagued by scandals and financial instability for years. In Switzerland, Credit Suisse teetered on the brink of collapse before being hastily acquired by UBS in a government-brokered deal. Across the globe, the cracks in the financial system are growing wider. And then there's the elephant in the room: China. China's banking system is a house of cards built on a foundation of massive debt. The country's property sector, which accounts for nearly 30% of its GDP, is in crisis, with major developers like Evergrande and Country Garden defaulting on their loans. Local governments are drowning in debt, and the shadow banking sector is rife with hidden risks. If China's financial system were to collapse, the shockwaves would be felt worldwide. So what happens if the global banking system does collapse? The immediate impact would be chaos. ATMs would run out of cash. Credit and debit cards might stop working. Businesses would struggle to pay employees, and supply chains could grind to a halt. The average person would feel the pinch almost immediately, with food, fuel, and basic necessities becoming scarce. But the long-term consequences could be even more profound. A collapse would shatter trust in financial institutions, leading to a shift in how people store and manage wealth. We could see a rise in alternative currencies like Bitcoin or gold as people seek safer havens for their money. Governments might step in with drastic measures, such as freezing bank accounts or nationalizing major institutions. And the geopolitical landscape could shift dramatically, with new powers emerging in the wake of the old system's failure. Of course, this is the worst-case scenario, and there are reasons to believe that such a collapse can be averted. Central banks and governments have powerful tools at their disposal, from monetary easing to emergency bailouts. The global financial system is resilient in many ways, with safeguards designed to prevent the kind of domino effect that leads to total collapse. But resilience isn't the same as invincibility, and the cracks in the system are becoming harder to ignore. So, what can you do? How can you protect yourself in an era of financial uncertainty? First, educate yourself. Understand how the banking system works and where its vulnerabilities lie. Knowledge is power, and being informed can help you make better decisions about your own finances. Second, diversify. Don't keep all your money in one place or one form. Consider spreading your wealth across multiple banks, investment vehicles, and even alternative assets like precious metals or cryptocurrencies. Third, stay vigilant. Pay attention to warning signs, whether they're economic indicators, news about your bank, or broader trends in the financial world. Being proactive can make all the difference in protecting your financial future. And finally, don't panic. Fear is the fuel that drives financial collapses. By staying calm and making rational decisions, you can weather even the most turbulent storms. The question of whether the banking system will collapse is impossible to answer definitively. But one thing is certain: the system is under strain. The choices we make as individuals, as governments, and as a global society will determine whether we can navigate these challenges or whether we'll face a reckoning unlike anything we've seen before. The future of banking, and perhaps the future of the global economy, hangs in the balance. The only question now is, are we prepared for what's coming?